Sapolsky of the Aspen Institute, and we're happy to have you all here and participating in this very first webinar that we have attempted ourselves. We participated in plenty of webinars, but this is the first one we've run, so we're hoping for forgiveness for anything we do that is a little strange. I'm going to get started. I want you to know that we already have about 30 people online and listening, and we're delighted to have you all. Part of the welcome is to tell you that this is the first in a series of monthly Rural Family Economic Success webinars. Now, we always abbreviate that by calling it RUFUS, so I'm going to be saying RUFUS a lot in the next few minutes before our presenters get started. So just so you know, for those of you who aren't totally inculcated in the Rural Family Economic Success Network, we call it RUFUS for short, and this is our first webinar. We're planning to have them every month through the end of 2009, maybe taking a month off in the summer or around the holidays. These webinars are wide open to anybody. The people who will get automatic notice of them are alumni of RUFUS peer learning events, site visits, conference sessions, and you know who you are. You are welcome, however, to forward notice of this to anybody in your organization or in your network or someone who you think would benefit from the particular topic we're going to cover. So you don't have to ask permission, and I don't think you'll have to ask forgiveness. Just do it. As of yesterday, more than 80 people had registered for this webinar, and some of those are groups. So we know for those of you who are groups, we can't hear you right now, but go ahead and give yourself a round of applause. Each webinar is being recorded, and it will be archived, so you and all your friends can watch and listen again at your leisure. You'll be able to download it. It can play on your screen, and you can listen to it. So if someone who you wanted to have in the room today or wasn't able to join in, or if after this webinar you think there's someone else you would like to see it, you are welcome to send them the link once we send it to you and let them watch it at your leisure or their leisure. And we all know we all have copious free time right now to do such things. So that was a small joke for those of you who may not have gotten it. We have companion material that we're going to email to you after the webinar, and in the near future it will all be available with a whole bunch of other material related to RUFUS on a convenient RUFUS website that will be something very easy to remember, something like www.rufus.org. And so, welcome. I want to give you a few notes, as we always have to do at the beginning of a webinar, on how you participate in the webinar. Right now, everybody on this webinar is muted with the exception of me. And we do that for a variety of reasons. Everybody's phone system has its own wonderful little vagaries, some of them being Muzak, but a lot of people these days work in offices with dogs. People aren't feeling well. There are all kinds of noise that when you have 40 or 80 people on the phone would be very disturbing. So everyone's on mute until we take you off mute. This is what we want you to do during the webinar. You'll notice that you've got a little window pane or control box or whatever you want to call the dashboard panel on your webinar screen, and you can collapse it or expand it as you wish using those double arrows. But if you have, during the presentations, if you have any clarifying questions, if you see that little questions box in your control panel, just type in a question. I will see the question, and I will try to find the right time to pose it. So if John says something like, starts using an acronym or something and you don't know what it means, you can just type in, what did John mean when he said APR? And I will let John know, and he will tell you what it means. So clarifying questions are really good to use the questions box for. The other thing is that if you have more cosmic questions that don't lend themselves to clarification, they're really more discussion questions, after each presentation, after John talks and after Brendan talks, and during the last half hour or so, we're going to have more time for questions, and in that case, we want you to raise your hand. And there's a little hand icon in your control panel. If you click on that, I will see it. I will see that you raised your hand, and I will call on people in turn, and you'll be magically unmuted when I call on you. If you don't want to raise your hand and go live audio, you can also just type in your cosmic question, and we will still see it, and we will still answer it. And finally, if you're having any technical problems right now, or if you have them at any time during the webinar, you can once again, use the questions box. Type it in. If you're still live, Elsa will see it, and she will do what she can to answer you or to call you or do whatever she can to help you. She is standing by. So that's how we're going to handle the technical stuff. If something on that is important and not clear, use your questions box right now to let us know. But also, as I said before, you can contact Elsa, and if some of you aren't getting a visual, her phone number is 736-5833, area code 202. There we go. Now, what I want to talk about, just to give you a tiny little bit of context, is these Rufus webinars are going to be focused on issues and questions and goals that are embedded in the Rural Family Economic Success Framework. And this was developed through work sponsored by and carried forward by the Annie E. Casey Foundation. The Annie E. Casey Foundation, I will also say, supports these webinars and our ability to bring them to you. Now, the Rural Family Economic Success Framework is focused on helping families accomplish family-focused goals. And everything that we do in the Rufus activity is focused on how can you help families accomplish these goals. And those goals fall into three broad categories: earn it, keep it, and grow it. And what I'm going to show you right now is the ultimate sort of outcome, or the really lead outcome we're going for under earn it, keep it, and grow it. Earn it is, we want this to be true for all families, low-income working families that we care about in rural communities, that those working families earn a living that allows them to survive, thrive, and raise their children in their community. We also want them, once they're starting to earn that living, to keep it. And keep it means that those working families have access to and make good choices that safeguard the income they earn in those jobs and that lower their cost of living and help them have more stable and predictable financial lives. And we know plenty of low-income people don't have that, especially in today's economy. And the third is grow it. The ultimate goal there is that working families, once they've earned it and kept as much as they can of what they earn, that they grow it into assets over time. So they accumulate and maintain assets that gain value and advance family and community prosperity over time. We have, for each one of these, for earn it, keep it, and grow it, we've developed a set of probably between 8 and 10 sub-goals, and our work is focused around those. Today, we're focusing today on keep it and a specific sub-goal in keep it. You'll see that we have a set of family-focused goals on establishing financial health that come under keep it. And the specific one we're focused on today is families get loans they need without using predatory lenders. And so the Nasty Nine presentation you're going to hear is really focused on things that keep families from getting ahead because they are predatory. Now, today's presenters are John Molinaro, my colleague here at the Aspen Institute Community Strategies Group, who really came up with the concept of the Nasty Nine and has put flesh on it so that we can deliver this news to a whole bunch of other people through the Rufus Network and through Rufus Peer Learning Sessions. As all of you know, even low-income people need to borrow money. We all need to borrow money at some point in our lives. Every family does. To buy a home, to buy a car, to buy that first piece of furniture in a medical emergency, in a family emergency situation. It's not like only low-income people borrow. We all borrow. The difficulty is that low-income people are charged higher rates, and that is the issue we're going to be dealing with. John is, as I said, the fellow who really put together the concept of it goes beyond just payday lending or the things we all know about. There are a number of other things, and he's going to be talking to us about that. John, I will also mention, is a Rufus Action hero in his own right, in that he worked for 20 years in rural western Minnesota for an organization called West Central Initiative that really embraced this Rufus framework and put together a whole series of region-wide activities involving a number of community organizations, government, and private business players to really advance family economic success in their 9-county rural region. Our second presenter is Brendan Wilbur. Brendan is a financial counselor at Alternatives Federal Credit Union in Ithaca, New York. And what's wonderful about Alternatives is it's a Rufus Action Hero organization. And what they've been able to do is to develop some alternative lending products that offer lending to low-income rural families at what are reasonable rates. And then finally, there is I, your moderator, and that is who you're going to hear from today. So I don't see any questions in the queue, so we're just going to move on to our first presentation on the Nasty Nine. And I am going to cede control of the PowerPoint to my colleague, John Molinaro. John?
Okay, Janet, I think, can you see the screen? Did I somehow?
I can't. Something happened. So I'm going to go back to my screen. Sorry, guys.
Okay.
I will simply advance it for you, John. There you go.
Thank you. Okay, just let me. Oh boy, I don't have the screen, so I'm going to work through my hard copy of these things.
Okay, that's totally fine.
Okay. Our apologies for the technical difficulties, and good afternoon to everyone. As Janet said, a few years back, I was beginning to look at some of these predatory lending activities, and started to understand that the scale of the activities was far, far larger throughout rural America and urban America too than many people realized. And so I collected a fistful of the most nasty of these practices and created something that we call the Nasty Nine. The first of the Nasty Nine is check cashing. So next slide, please. Check cashing services are in America are used by about 1 in 4 low-income families, or about 1 in 12 families overall. Many of those are people without bank accounts, but in addition to people without bank accounts, the check cashing services are used by many folks because of some of the characteristics of our banking system. Most banks will hold on to checks, even paychecks, for a number of days before they'll make the deposits available. And as everybody knows, low-income families often need their money as soon as they get it. So even if they have a bank account, many low-income families will go to check cashers. And in addition, low-income families will often go to them because of convenience. Rather than driving across town to where a bank branch might be, they might go into a check cashing operation that's operated out of, say, a convenience store near where they live or where they work. So there are lots of reasons why families there are lots of reasons why families use check cashing operations. Those operations charge between 3% and 7% of a check's face value in order to make funds available to folks. And that doesn't seem like much, but if you're earning $13 an hour, making about $500 every week, you'll ultimately pay a minimum of about $1,000 in a year in order to cash those paychecks if you use a check casher. And if those that are the more costly paycheck or check cashers could charge you as much as $2,000 out of your, in this case, $26,000 income, in order just to cash your paychecks, which are very, very safe checks. In 2004, these operations sucked $205 million out of low-income families' pockets just for cashing tax refund checks, which are about the safest checks in existence. The overall impact on low-income families of these check cashing operations is in the billions of dollars. And what really makes this a little bit worse is that so many of the check cashing operations also offer other kinds of predatory transactions that are even more costly, like payday lending and car title lending. In the states where payday lending is allowed, 2/3 of the check cashers in the states also make payday loans. Moving on then to the second item here. Next slide, please. Buy here, pay here car dealers are number 2 in out of the Nasty Nine. And the buy here, pay here car dealers are the folks who that you may hear advertised on radio or television who say, no credit, no problem. And they really cater to low-income families that have credit history issues and therefore may not be in a position where they can buy a car in a conventional automobile dealership or directly from an individual. These folks really sell bad cars to desperate customers, and they sell them usually for 50 to 100% more than the cars are worth. In fact, some studies of this industry show that in most times when somebody buys a car at a buy here, pay here car dealer, they're paying every penny that that car dealer paid to purchase that car at an automobile auction. And these dealers basically buy cars that no one else, no reputable automobile dealer will buy at an auction because of their condition, usually their mechanical condition. And so these dealers obscure the true price of the vehicle. They don't really talk about what it's costing to buy the car. Instead, they use sophisticated computer programs to try to determine how much somebody can afford to pay. And so they sell the car based on the payment amount, not on the actual cost. And where they really make their money is by extending the amortization for a very long period of time, often longer than the remaining life of the car. Since they're getting most of their money back from the down payment on the car, every time they get a payment, and usually, and oftentimes it's for 4, 5, 6 years for a car that may have a year or two of life left on it, that it soaks cash out of the buyer. That's pure profit for these dealers. Their interest rates can be astronomical. They started a 25% APR. Now, APR, for those who aren't familiar, is annual percentage rate. It's an apples-to-apples term that looks at both the fees charged in a loan and the interest rate charged by a loan expressed on an annual basis. The APR loan, the 25% APR would be equivalent to a loan interest and fees of 25% a year. We're going to talk about even more costly APRs in some of the other nasty 9 here. These loans are usually structured for people to make a payment every payday. And if the payment is missed, there's instant midnight repossession. The dealers usually keep a spare set of keys. And on average, one recent study showed that on average, the cars that are sold by these dealers are repossessed and resold about 5 times a year. It's pretty phenomenal and a little bit more than a little bit disgusting. The next item that we have is courtesy overdraft loans. Now, this is something that you probably have on your bank account, and you may not have ever used it because most of the major banks in America now do this as a default term in their lending. These are automatic loans to honor checks when you have exhausted the funds in your account and otherwise would have a check returned or bounced. These loans are also made for ATM withdrawals and cash card transactions, your bank debit cards. In many of these banks, because they call this a loan rather than a non-sufficient funds charge on your check, oftentimes they charge more for these loans than the state limits on overdraft fees. If you don't pay them back immediately, they'll then charge an additional fee. They'll call it sustained overdraft charge. So while it's not bad in and of itself to have your bank cover a check that would otherwise bounce, when you start linking that with some of these other practices, it can get very, very expensive very quickly. Because they're considered a loan, they're not subject to consumer protection laws governing overdrafts. And the banks almost all the major banks have moved to a system where they process customers' deposits last and their checks first in largest to smallest order to maximize customer fees. So if I'm writing $400 worth of checks today and I make a $500 deposit today, they'll count that deposit later. And so I may bounce those $400 in checks, or I might get charged for these courtesy loans on those $400 worth of checks, even though I made an effort and I actually put the money in the bank on the same day. And by doing largest to smallest, they draw down the money that you have available in your account very quickly, and resulting in a lot of small transactions resulting in these fees. So a $3.50 charge on a cash card at Starbucks for coffee might end up with a $35 courtesy overdraft loan. In fact, these things are so much bigger. Many times, because these are relatively small amounts of money and they're very large charges for them, most times, the amount charged is actually in excess of the amount that's of the overdraft loan. $17.5 billion in 2007 in these in bank charges to make $15.8 billion in overdraft loans. If the banks didn't get one penny of those overdraft loans back, they'd still be ahead financially. Moving on. To payday loans. Now, payday loans are probably the best known of the various kind of nasty nine. And that's probably because it's one of the nastiest of the nastiest nine. Very much the most lucrative predatory lending practice to those who are actually doing the predatory loans. A payday loan is a loan that's secured by a post-dated check. So you walk into a payday lender, and 2 minutes later, if you can show, the first-time transactor, if you can show a pay stub to show them that you have money coming in, and you have a checking account, and you can write them a post-dated check, you can walk out with money. Very, very convenient, but there's a very big cost for the convenience. That APR, annual percentage rate, runs from 650 to 780%. So borrowing $500 for 2 weeks costs a typical borrower $625 to repay it. At that rate, in 2 months, that's with 4 rollovers of the loan, the payday lender has made as much money in interest as they've lent to the customer. And the average customer rolls over a loan 8 times, and so they pay twice the original amount of the loan in interest. Over the course of a year, if a lender's got $1,000 to lend, that's what they're going to end up having $6,000 in interest and fees that they earn in income from these payday loans. It is about the most lucrative financial transaction that there is for the people who invest in these payday loan stores. And the people who own these stores include almost all of the big banks in America. They're heavily, heavily invested in this, which is why they don't fight this practice or see it as competitive. Many of them own significant chunks of the payday lending industry in America. $500 rolled over for a year costs $3,900, up to $3,900 in interest and fees. And even if you're in one of the states that's attempted to regulate these payday loans out of existence, there's a very, very good chance that they're still occurring in your community. Banks, in many places, in many states, banks rely on the protection of the federal interstate banking laws and claim that they're exempt from state laws. And then there are also internet and telephone operations where I could be living in a state that regulates these, like Pennsylvania, and I could go on the internet or make a phone call and borrow from a firm that's located in some other state that doesn't regulate them. So they're accessible even in places like rural areas that might not have a payday loan store in every retail payday loan store in every corner. These things are so lucrative that there are more payday loan stores in America than McDonald's and Starbucks combined. The next of the nasty nine are refund anticipation loans. These are short-term loans that are made by tax preparation chains for people who want or desire or are desperate to get their tax refund immediately. They're marketed by these firms as being instant refunds, not as loans that have to be repaid. And when you add up the cost, it equals about 235% APR to get the refunds 5 to 7 days earlier. In addition to that, these loans are often coupled with really expensive tax preparation fees. A very simple return that at a private accountant might cost $40 or $50 typically will cost $146 at a firm like H&R Block. So poor families spent an incredible amount of money on this, almost $1 billion in 2006, $900 million in loan fees, and I'm sorry, $900 million in interest, and $90 million in document processing fee charges that were added to these loans by the retail tax preparation changes. If you were to take a map of America and color in red all of the places on the map where poor people live, and where the military bases are located, and where Indian reservations are located, and communities that have high numbers of minority residents, and overlay it with a map of the tax preparation chains that offer these loans, you'd find that it was almost a completely identical map. They really target poor communities. The tax preparation change, you might think that tax preparation change would go to places where people have money to pay to have their taxes done. That's not the case. People with money tend to use private accountants who are actually charged significantly less to do a return than the chains do. Okay. I'm sorry, I'm having trouble advancing this. Number 6 is rent-to-own. Rent-to-own is legal in about 48 of the 50 states, and what it is an attempt to suck cash out of the pockets of low-income folks by who wouldn't be able to afford or get credit to buy something on a normal retail credit relationship by renting the item to someone with the ability for the person to buy. By itself, that doesn't sound too bad. Somebody makes small weekly payments, to rent something, but what ends up happening is that they really charge very, very exorbitant interest rates to do these kinds of fees. So the interest rates and the fees for buying something like a $200 television, over a year and a half, that television would end up costing the consumer typically about $700, $8.50 a week for 78 weeks, and a $37 buyout fee. Why would somebody pay $700 for a $200 TV? In some cases, it's because there's something somebody wants or something somebody needs that they simply can't find another way to purchase. The interest rates and fees on these loans run from 100% to 300% APR. And one of the things that really makes this difficult on the low-income consumer is that because these are considered to be loans, in most states there's very little protection for the consumer. The companies that do the rent-to-own transactions can walk in if you're a day late with a payment and yank an item. In many places there have been documented use of illegal strong-arm tactics by these rent-to-own operations in order to repossess goods even faster than the law allows in the states. So again, these are generally very unscrupulous operators. Next slide, please. The seventh of these nasty 9 are subprime mortgage loans. And of course, everybody's talking about subprime mortgage loans in this economy. And in fact, if you listen to the debates in Congress, it seems like that some folks are blaming the borrowers for these loans failing, blaming people for borrowing, seeking loans that they knew they couldn't afford. In reality, subprime loans can be useful if somebody doesn't have a really good credit record for getting into a property that's reasonably priced. But they can become predatory very, very quickly. They can become predatory when a lender steers a borrower who can qualify for a conventional loan into one of these subprime loans at higher interest rates. It can be when they load things up with excessive points or fees or insurance, it can become predatory in a hurry. Many times, $5, $10, $15,000 worth of prepaid points, fees, and insurance might be loaded onto the front end of one of these loans. Money that the borrowers aren't told they really don't have to pay to make these transactions work. Or they assess a high prepayment penalty. In rural communities, you are 20% more likely to have a prepayment penalty for paying off your loan in more that's greater than 5 years in length. So if you attempt to pay down your principal or pay off your loan within 5 years, in many of these cases, you're going to get charged a really, really big fee to do that. Then there's a practice called flipping, which is where there's really no benefit to the consumer or very little benefit for one of these subprime mortgage loans. But people in some neighborhoods will actually, and in some rural areas, will actually go door to door and say, we can get you some equity out of your home. The people get a very small amount of equity, but then they pay a very, very big price to do that. Sometimes people have been flipped 5, 10, 15, 20 times and have racked up so much more in fees for these flipping transactions than their homes are worth, that they end up losing their homes because of those fees. Then one thing that really makes me mad is something called a yield spread premium. If you walk into a mortgage broker, you think they're working for you, but they're not. And most borrowers count on the mortgage broker to find them a good deal on a loan. But the mortgage brokers are allowed and, in fact, encouraged to charge you as a borrower more for that loan, to negotiate an interest rate that's actually higher than you'd qualified for, and the mortgage lenders then provide a kickback called a yield spread premium to the mortgage broker for getting you in a higher priced product. Basically, they split the profits. And then a really, really common practice in rural areas and also in low-income neighborhoods is to steer smaller loans into subprime subsidiaries of larger lenders. So almost any of the big banks in America, and for instance, I know well that Wells Fargo is one that does this, have minimum sizes for their conventional loans that are relatively high. So say you live in a rural community where the average value of a house is $75,000 or $80,000. If you walk into a bank like like this, what they will do is they will steer you into a subprime loan even if you have perfect credit, just because you're not borrowing as much as somebody else might. That's really backwards, and that's the kind of thinking that got us into this mortgage crunch and crisis that we've all been coming through lately. The next of the nasty 9, number 8, are title loans. And this is really relatively new and fast-growing form of predatory lending that's really not very heavily regulated. This is really big in rural areas because in rural areas you almost have to have a car in order to have a job or to have a life. And so what a car title loan operation does is makes a short-term loan, like a payday loan, but it's secured by the car title that the lender hangs on to. There's usually at least a 25% per month charge for these loans. That works out to 300% APR, which is 10 times the cost of even a high-risk car purchase loan. So if you walk into a buy here, pay here car dealer and buy one of their pieces of junk, you're still likely to pay 1/10 as much as you would if you take the car that you own outright and you borrow a small amount of money against the title. The lenders that make these loans usually hold a set of keys, and they'll repossess the minute you miss a payment. In many states, the law allows them to keep the whole value of the car when they sell it, even if you only owe them a few $100s or from one of these loans. So there's a great incentive for the lenders to repay the moment that they can legally do that. And some of them have been known, and there have been many documented instances of these lenders going ahead and repossessing cars even when they have no legal right to do that once they have their hands on the title, because by doing that, they can profit immensely. And finally, there are credit cards. The Nasty Nine, when I first put it together, it used to be called the Evil Eight. But the more I learned about how credit card activity in America operates, the more I realized this has to be part of what I talk about here. Credit card companies in America make their money from troubled borrowers. That's where the real profits are in the industry. They target families and youth with little or no credit history. The average family in America gets 250 offers of credit cards a year, which is quite mind-boggling when you think about it. There are affinity cards targeted towards kids, like Hello Kitty affinity cards. One of my former coworkers once got a credit card offer addressed to her dog after she subscribed to a pet magazine as a joke in the name of her dog. The companies really don't care as much about whether you've got a credit history because they make their money from their borrowers that get in trouble. Late fees and penalties in 2005 equaled 75% of the profits made by credit card industries. And they are the only industry in America that once you've completed a financial transaction can go back and retroactively penalize you and raise your interest rate. So you may have, if you borrowed money last month at 18% interest and they decide they're going to bump up your interest rate because they don't think you're a good risk anymore, you're going to pay, and you haven't paid off that money from the past, you're going to pay that new interest rate, maybe 28% or 38%, on that old balance. No other industry can do that. There's also this thing called universal default, which means if you get a little bit behind in a payment to some other borrower, or if your credit score goes down because maybe you got a new credit card offer and consolidated all of your debts with that credit card operator, and used up most of the interest rate on that, that can lower your credit score. If your credit score goes down, or if you get behind in another card, all of your cards can declare you to be in universal default and bump up your interest rates. Well, if you were having trouble before and you bump the interest rates, which bumps the minimum payments on these cards, it can really sink you into a downward spiral that ends up in bankruptcy or worse. There's also this practice called two-cycle billing, which is real interesting. If I pay off my credit card one month and don't pay it off the next, some credit card companies, most of the big ones, will charge me interest on the month when I'm not even carrying a balance by averaging my interest this month with the interest from the month before. It's called two-cycle billing. And then they manipulate payment order. If I get that introductory rate for the card that says 0% for a year, or on the balances that I transfer, well, then what they'll do is they'll apply every penny I pay to those 0% balances so that they can charge high interest rates on every penny I charge after that introductory period. And finally, there's something called fee harvester credit cards. These are credit cards that are secured. So if I don't have a credit account, I might go to a bank and I might take out a secured credit card, say a $250 secured credit card. So I put $250 down thinking that means I'm going to have $250 that I can charge. But these fee harvester cards on average will charge $178 in fees against that $250 the minute I set up the account. So when I'm done, I have $72 worth of credit left. I go out, I charge something for $100, and immediately I'm in default, and the interest rates go up on those cards, and I get charged with additional fees and penalties. It's a really, really nasty practice. The good news here, that because in part of the economic crisis we have, the Federal Reserve has taken another look at some of these credit card practices, and last December, there are some that are footnoted here that were banned in part or totally beginning July 1st, 2010. Well, if they could do it for 2010, I'm not sure why they couldn't do it immediately, except the industry said, well, we need time to adjust. Actually, I think they needed more time to make these the high profits they make from these cards. But the industry is fighting tooth and nail to try to get this rolled back. And so July 1st, 2010 could very well come, given the amount of money that they're pouring into these efforts, and see these reforms reversed. So this is an important policy point if you're concerned about these issues. So what does all of this lead to then? Well, it leads to something I call 21st century credit slavery. And that's a situation in which more than 1 in 4 of our low-income families in America pay more than 40% of their income to service debt. That's an incredible amount going out the door, out of the pockets of low-income families. And because of the changes in the bankruptcy laws a couple of years ago, you really can't escape debt the way you used to. So the credit card companies are counting on the bankruptcy courts to uphold their right to collect that money from you, even if they essentially cheated it out of you in the first place, as are these payday lending and other operations. So a low-income family can be trapped into extraordinarily high levels of debt forever under the current laws. It's a very, very difficult situation. That's about it for the Nasty Nine. I'm going to turn it back to Janet.
Sorry, I was muted. I got unmuted and then something muted me. I'm not sure what. I'm so sorry. As I said, now it's time to ask questions. If you have a question, please feel free to raise your hand. And you do that by hitting the little hand icon in your control panel. John, as you can tell, is pretty passionate about a lot of this and has developed a lot of knowledge about it, as has Brendan, who is also on our call. So if you raise your hand now, I will call on you, and the other thing you can do is type a question. While we're raising, and I see a couple hands raised now, but while we're waiting for more, I do want to mention that several people during John's presentation mentioned to me that, or wrote me little messages in the question box asking whether they could get copies of the PowerPoint. And the answer to that question is yes, we can make those copies available, and we'll let you know about that in a follow-up email. Other people asked about what the acronyms were for the sources in John's PowerPoint. There were some sources at the bottom of some of the pages, and there were acronyms. We have a handout you'll get that will have all of those sources spelled out. So I just want you all to know that. The first person I have in the queue has had her hand up a long time. I'm not sure if she has a question, but it's Pam Bream. Pam, do you have a question? Pam, I've unmuted you so you can speak. Pam Bream, do you have a question? All right, then I'm going to remute Pam. Jill Loram. Jill Loram, it says you have a question here, and I just unmuted you.
Yes,
Go ahead, Jill.
Okay, Janet. As far as the buy here, pay here auto dealers, can you recommend, do you have any recommendations for helping me to steer people away from those types of dealers? What should I be looking for? And are there alternatives that you know of that are perfectly safe and are not out to rip people off?
Sure. The first thing I do is I'd look around your community and see if you've got a credit union. Most folks assume, and often not correctly, that who use these dealers assume, and often not correctly, that if they go to the right lender, like a credit union, they're not going to be able to get a loan. The very best situation is usually when someone is at tax refund time, when they've got a fairly significant amount that they can use as a down payment, and working with a conventional lender like a credit union. Beyond that, there are examples around the country of services that have been developed in places to help get low-income families into more affordable new cars, newer used cars. Fannie Clack is an operation that in New England that does that kind of work. There are, but there's some.
Bonnie Clack. They've renamed.
I'm sorry, Bonnie Clack. Right, they had to rename themselves because Fannie Mae objected. In Wisconsin, there's a program called Jumpstart. There are a variety of programs around the country that have been created at the community level to try to provide an alternative for those whose credit really would not generally allow them to buy from a dealer, even with the help of someone like a credit union. Those are probably the best options that I can think of.
Okay, Jill?
Do you happen to know Bonnie Clack? I know we've been trying to get them to come to Maine, and we haven't heard anything, and it's taken a while. Do you know whether Bonnie Clack I would be able to utilize Bonnie Clack for my participants in my program here in Maine?
The last that I heard talking to Robert Chambers at Bonnie Clack was that he was in the process of and thought he was rather likely to obtain some funding to through a broader portion of New England with his service. But I have not heard specifically that he's secured that funding. So,
well, Jill, the last time I looked at their website, which was a few weeks ago, I noticed they had offices in states other than New Hampshire at this point. I think there was one in Connecticut. So part of that, so you should just keep trying to reach Robert. The other thing that is an interesting thing is the program in Wisconsin, Jumpstart at WestCap. They actually serve as a dealership, and people from other states, cap agencies from other states, sometimes will purchase their cars through their auto dealership. So you could talk to Peter Kildee at WestCap in Wisconsin as well to see if there's some ideas he might have for you about how you might go about this.
And in fact, many of the cars that they purchase from the large auto auction in Pennsylvania, and so transportation would not be as much of an issue as it might appear in dealing with a Wisconsin-based dealership. So
we have a number of other questions. So if you have more you want to follow up on that, Jill, just contact us and we'll give you the contact names. Okay?
Thank you.
And Jill's at Coastal Enterprises, by the way. I should have asked you to say where you're from, and if you would do that, that'd be great. I've got a couple of questions that are in the question box, and I'll get to them after our next live caller. The next live caller is, or participant, Lisa Helm. Lisa, I've unmuted you. Can you give us your question? Lisa? Are you there, Lisa? Okay, Lisa, we're not hearing you, so and she's from the Vermont State Treasurer's Office. If you want to type your question in, Lisa, we'll take it in the question box. One more live caller, Robin Bahar. Robin?
Hi. This is actually Martha Maxim. I'm here with the Cash Coalition in Burlington, Vermont. And it's less a question, but more something that we've tried here, where we're working with employers who are offering their employees, just by virtue of being in good standing as an employee of a particular company, access to an emergency loan, same-day loan through a credit union in our area. And the person can get the loan regardless of their credit. It's paid back through payroll deduction to the credit union, and we've actually had at one company about $35,000 in loans made in the past year. There have been no defaults on them. This is directed at a lot of the lower wage employees who ask their employers for advances on their pay. So it's been a great service for people that get in trouble and need access to emergency cash to be able to do it through their employer with a credit union. They can repair their credit or build their credit, and we've actually seen some employees shift once the loan is paid off and they haven't missed the deduction out of their pay to actually start saving. So it's been a really nice way to move people into savings by giving them access to non-predatory emergency cash loans.
Cool. John, any comments on that?
Other than absolutely great example of how you can creatively address some of these issues, that's super. Thank you for that information.
Thanks a lot, Robin. We've got a couple of written questions. Some are quick, some are not. The first one, though, came from Paul. Paul, I'm looking for your last name, but Paul. John, I understand that Walmart is using some of these tactics, such as check cashing. Can you comment?
Yeah. Walmart, my understanding is that Walmart does do some of these things. I think because of their high public visibility, what I understand is that they're generally not at the extreme end of the APRs for these practices. But I do understand that they do offer some of these services like check cashing services. Many supermarkets, for instance, offer check cashing services, but usually in those circumstances you have to pay they limit the size of the check, and you have to use a portion of it on their on buying groceries there or things like that. So there are many retail companies that do offer a form of this in not quite as predatory a fashion.
Here's a quick question, John. Kim says number 3 of the Nasty 9 was courtesy overdraft loans. You called it courtesy. Is this the same as the overdraft protection that banks ask if you want to get this or not?
Most of the large banking chains in America do this on an opt-out rather than an opt-in basis. So this has become so lucrative for the banks. People very seldom default on these overdrafts. They almost always pay them back, and they made $17.5 billion in fees from them last year. Why wouldn't they do this? So most of the large banking chains have gone to an opt-out. They don't even unless you read all the disclosures you get when you open an account, you may never know that they are offering you this service. That it's an automatic part of your account. And honestly, if you're given a choice between bouncing a check and having the bank honor a check, you may ultimately be better off to have them honor the check. The problem is when they're combined with these some of these other tactics that are really designed to strip wealth from out of your accounts, to strip money from you. And so there are some banks that offer these as opt-in practices where they say, do you want to sign up for this? Usually when they're asking you if you want to sign up for it, it's a sign that they're asking you to sign up for a service that is more likely to actually be beneficial to you. The ones with opt-outs are usually the ones that, rather than opt-ins, are the ones that are usually more predatory.
So what I'd like to do now is there are a few other written questions in the question box queue, but what I want to do now is some of them will also be relevant after we hear from Brendan. So what I'd like to do now is move to Brendan because part of the question is, so what the heck can we do in rural communities or rural places to counter some of this? And so Brendan Wilbur is now going to join us. Brendan, I'm going to attempt to give you the keyboard and mouse, and let's see if that works. And see if you can advance to the next slide. Otherwise, I'll do it for you. And take yourself on mute and get us started.
All right, I had it there for a second, Janet, but there we go.
You did it.
So thanks for that warm introduction. My name is Brendan Wilbur, and I am a financial counselor and IDA coordinator at Alternatives Federal Credit Union in Ithaca, New York. I do many things here, wear many hats like I'm sure many of you do in your own field. And I'm here to talk to you today about some of the products that we offer to help counter those nasty 9 that John was talking about. And those nasty 9 are located in every one of our communities. And like John said, they really are preying on lower income folks and people in rural communities. So, as I said, I am from Alternatives Federal Credit Union, and I'm trying to get the slide to advance. There we go. And this is our kind of model of how to get the unbanked person along this thing that we like to call the credit path. And it's just a simple illustration of what our mission is all about. Our mission is helping the transactor make their transactions without those check cashing fees that John was talking about. A cheap way, a free way for our members to come in and get their checks cashed so they can live their lives without paying fees for a simple thing as getting their payroll check cashed. The next step through education and experience is we start working with them to save money, saving towards getting assets, saving towards putting money towards shared secured accounts, which we'll talk about in a little bit. But you see there's a shortcut there. It's IDAs and education. And I hope everybody on this call is familiar with IDAs. They're individual development accounts. They're match savings accounts. They're an amazing tool, and they're located throughout the country. And I'm happy to give more information on that on an individual basis if people are interested. But education, again, moves people on into the borrower stage. Too many times people want to go straight from transactor to borrower or owner without learning to save or without learning how to properly borrow money or properly how to manage their account as a transactor. So we work with individuals through financial education, financial counseling, the education and experience to help them along this credit path. Obviously, when you become a borrower, which is something that as a credit union we need our members to do, we're still expecting them to be savers and transactors. I'm going to talk to you today about the borrower stage. The borrower stage is really not only about having access to affordable money, but it's also about building a positive credit history. If you have access to loans, but you're not being supported, you're not being giving the education, and you're harming your credit, it might not be doing you much good. So after the borrower, you see that helps lead to the owner stage. Some people, owner stage could be a simple asset such as a car. It could be a home. It could be a business. Our goal here at Alternatives Federal Credit Union as a community development credit union is to educate our members to see what their best options are. But as I said, we're going to talk about borrowers and some of the products that we offer here at Alternatives. And as I get the next slide up, here we are, shared secured loans. So a share, if you're not familiar with credit unions, is a term for an account. When you have a bank account, it's basically a savings account is what you have. Here at Alternatives, instead of having a savings account, you have a share account. So when you put your money into your savings account, we just call it a share account. Now, with a shared secured loan, this is a great opportunity, and as a financial counselor, this is one path I send people down in order to build that credit history. The person comes in with no funds of their own. They borrow a certain amount of money. In this example, I'm going to use $500. We place that $500 into a share certificate, which is much like a CD or a certificate of deposit at a bank. That CD, share certificate, in this example I'm going to use, is earning 2% interest. That means the loan that they took out is going to be charged 4% interest, or 2% above what the shares are earning. This is, in essence, a forced savings habit. It allows the person to build a credit history. It allows us to loan money to any individual who walks in the door, regardless of their credit history. If someone has a 470 or a 450 credit score, this is the perfect opportunity for them to start to write that. The loan is paid off. This $500 loan, they're going to be paying $43 a month. It's going to be a $10 fee when all is said and done. They're going to end up with $510 in their savings account at the end of the year after paying $520 into it. That $10 has helped them build a credit history. They've basically had a forced savings habit. Now, at the end of the loan, they have $510 waiting for them. Like I said, $510 in that forced savings goes back to the credit path. It hits not only the borrower, but the saver. And we're educating them on they do have the ability to put that money aside and move towards building a positive credit history. So the next thing that I would work on with somebody from here, if their credit is in really poor shape, that's the first place I'm going to start. The next slide, I think you have control now, Janet. The next slide is something very similar, and this is something I might graduate somebody into. Now, the shared secured loan was an amount that they didn't actually have access to. It just helped them build a credit history. Now, the shared secured credit card, this is something where they're actually going to have money available to them. Now, John mentioned when he was talking about credit cards as being part of the Nasty Nine, and I couldn't agree more that credit cards are part of the Nasty Nine. He mentioned a fee harvester card. This is nothing like a fee harvester card. This is an account where they're going to put their money into a certificate of deposit. This is one where they come up with the money. So if someone started with a shared secured loan, they graduated with $500, we might look towards a shared secured credit card next. Putting that $500 into a CD or a share certificate, that allows them to have $500 available to them on the credit card. It's a safe and effective way for someone to learn how to use credit effectively. There's a limited amount of trouble they can get into with this. If they're having a hard time making their payments, or if we notice there's a missed payment, we contact them. We start working in financial counseling to see what's going on. If they're not able to make the payments which they've set themselves up with, we'll suggest that they close the CD out, pay off the loan before they're getting into a 30-day late period and hurting their credit. This allows them the opportunity to try a credit card. I generally try and encourage our members to put one thing on it a month. Put that phone bill on there, something that's a constant. They know how much it's going to cost. Instead of putting all their groceries or all their gas, put the one phone bill on there. They were going to pay that anyway. They make the payment at the end of the month. They're building a positive credit history, and they still have funds available in case that emergency arises. These cards are only limited by the amount that they want to put into them. So after tax season, I have folks come in and open shared secured credit cards in the amounts of $2,000, $3,000. The interest rates, the highest we'll go on our credit cards is 18%. With the shared secured, I believe the rates go anywhere from 8 to 15%. So it's a safe way for individuals to build credit and learn to use a credit card without getting into trouble. Really effective tool for low-income folks and folks in rural areas who don't have access to typical credit. All right, can we go to the next slide? Next thing I want to talk about is another type of the Nasty Nine that John had mentioned. And refund anticipation loans are extremely nasty. They're so nasty that here at Alternatives Federal Credit Union, we decided we needed to start our own VITA program, or Volunteer Income Tax Assistance Program. That is a special program in partnership with the IRS where we train volunteers to do our community members' taxes. Not our credit union members' taxes, but our community members. You don't need to be a member of the credit union in order to come here and have your taxes done through our VITA site. We do offer folks free memberships to the credit union so we can get them banked, we can get them out of the check cashing services when they come in for their VITA appointment. Now, one obstacle we ran into when we started this VITA site was folks wanted instant access to their money, which places like H&R Block will offer you. And they'll offer it to you for that low APR of 200 to 300% interest for the loan that's going to last 5 to 7 days. Well, we decided the best way to counter that was to offer our own, but also to offer the education that goes along with it. So with our refund anticipation loans, we do it, the taxes for free. If they need to have the money that same day, we'll do it as basically a line of credit where we'll file their taxes, we'll submit them electronically, have it e-filed so we'll come back to their account here at the credit union. We'll charge them $20 for that refund anticipation loan, but we'll give them instant access to their money. This is not something we're encouraging our community members to take, though. We're talking to them about the money will be here without that $20 fee within 5 to 7 business days generally. The loan is guaranteed through their tax return, so the credit union or financial institution that's offering it is not at risk. It enables individuals who need a fast refund to use the VITA site. I'm proud to say We offer this, but it's not utilized like we originally thought it was going to be utilized. Out of the 1,300 returns that we filed last year, I believe we had 20 people use this program, and it was because of emergency financial needs. I actually worked with a few of those people in planning for the future and looking at emergency needs and how to meet those in the future, not around taxes. So we got to combine education with the refund anticipation loans. And these examples I'm giving you, hopefully we all have VITA sites in our area. If you are not sure if you have a VITA site, we can help you find those. You should be able to find them right through the IRS website. If not, I can give you contact information on where they are. But they are located throughout the country, and they are a great opportunity, not only for your community members to learn how to do taxes as a volunteer, but also to offer free tax preparation to lower income and rural community members in your area. Okay, next slide. The next slide was another one of those that was on John's Nasty 9, and here at Alternatives we're trying to counteract that Nasty 9 by having much more consumer-friendly products. Our payday loan plan, or payday loan product, we call a payday credit plan. This is available to our members, which to be a member of a credit union, to be a member of our community development credit union, you just have to be a member of or a resident of our county or one of the 6 surrounding counties. Many credit unions in your area probably have similar criteria, and most of the unbanked and rural folks don't understand that they can join a credit union. They don't have to be a member of a certain organization. They just might have to live in the area that that credit union serves. So this one is a special loan product designed to meet immediate cash needs in emergency situation. The other products we've gone over have been tied to, shared secured loan, shared secured credit card, or the refund anticipation loan. This one is to meet those immediate cash demands. So it's structured like a line of credit, and it carries a one-time $40 annual fee and an 18% APR on it. Now, what I want to say about this, I'm going to give the example of a $300 loan. A typical $300 loan through us in this program will cost the borrower $4.86 a month in interest, as opposed to the staggering rates charged by predatory lenders. Now, 5% of every loan is deposited into a savings account for the borrowers to build funds for future financial emergency needs. This goes back to the saver stage of our credit path. So if someone comes in and they want to borrow $300, 15 of that is going to go into a savings account for them. The average person uses a payday lending product 8 times a year. That $40 annual fee is a one-time fee. They use it 8 times. They only paid the fee once. If they go to a payday lender, they're going to pay that fee every single time. So that $80 fee is going to rack up like John was showing us. This is a one-time fee. So if they use it 8 times, they're not going to be paying any more for the product by using it. Now, if they use it 8 times and they use it for that same amount, that $300, at the end of that, they're going to have $120 now built up into a savings account. Our goal is to build them up and build them up if they need to use this product until they have an entire paycheck set aside. I have had members go through this program and use it 10 and 12 times in a year. It's not ideal to fall into a trap like that, but for the interest that they're paying and for the opportunity that it's allowing them, it also builds their credit report. We're going to report it as a loan to the credit bureau agencies, and there's not a way for them really to default on it. The loan must be paid off with the next pay period or benefit check. We have people use direct deposit for this. We also are able to use people's SSI for this. In where it says there at the bottom, it can be renewed with no additional fee. That's really the key. Payday lending products in general are not a good way for folks to go, but if it's the only option that they have, this is an option where if they fall into the trap, it's just a one-time fee, and they're able to build a savings habit out of it. Now, if someone's going to enter into this program, I'm also going to want to speak to them as a financial counselor and educate them and make sure what else is going on in their life. We're going to be looking at their household spending plan. Notice I didn't say budget. I imagine that word budget for me sounds like the word diet, and it does to many of my members, so I try and stay away from it. We use the word spending plan. And it's really important that we use education with all of these products that I've gone over. Otherwise, they're going to fall into traps. So those are the 4 main products that I wanted to talk about. And the reason I chose those 4 is because I feel like those 4 are very easy for any financial institution to offer in your area. These aren't special products that only we can offer because we're super special at alternatives. No, these are general products that are safe and secure that we are not having defaults on. These are products that are secure for our members, they're secure for the credit union, they help the credit union, and they help the members. Now, if you have a credit union in your area, and that's the first place I would start, I would go to them to look at products that they might be able to offer, such as these. And if they're not offering them already, you can send them to us and say, talk to Alternatives about things that they're doing, because we're interested in having that for people in our community. If we could go to the next slide. I just wanted to give you a picture of Alternatives Federal Credit Union. Just 8 years ago, we were located in a house. We were a credit union out of a house in downtown Ithaca, and we slowly have been growing over the last 30 years, and we just moved into this fabulous building in the past 7 years. It feels a lot different than when we were in our little home, but it's very welcoming for our members. We have a very casual appearance, and it helps our members really at ease. So that's really what I wanted to talk to you about today, and just share some things that we're doing at Alternatives, which I'm sure are being done out there in your community as well, and I'm sure there's products out there that are just as amazing as what I feel like these are. So I think we're at a point in time where we can get back to some questions. Janet?
We certainly can, and I want to thank Brendan. As I said, Alternatives Federal Credit Union is a, we call it a Rufus Action Hero organization, and I want to point back to, you may have seen that drawing of the credit path that he had, or the image of the credit path he had at the beginning of his presentation, and we found that that picture by itself is really helpful and useful to use with customers of all your programs in helping them identify where they want to be and helping them understand that every American, not just or every person in this country, not just low-income people, land somewhere in that path and have to move up that path, and they're just another person on the path that needs to be moved, and what's the next thing they need to do. It helps with goal setting. So we have a number of questions, written questions in the queue that are relevant to what you said, but I also want anyone who's got a specific question for Brendan to go ahead and raise your hand if you're going to want to be unmuted and ask it live. Otherwise, you can either raise your hand or type a question right now. And while we're waiting for people to raise their hand, I've got a couple questions here, Brendan, that I think you or John, if you want to join in, you're welcome to. Wynette Taylor at Community Action Commission in Perry County, Dauphin County, and Cumberland County, Pennsylvania asked, when working with a client for credit counseling and the amount of debt is overwhelming, where would you recommend we start? So in other words, if someone walks into Alternatives and they may not be ready for those products, where would you start them?
First thing we're going to do, if someone's coming in and they're feeling a little overwhelmed with the debt that they have, we're going to look at their household spending plan. We're going to go through what their income is, what their household expenses are, and what their debt is. I need to separate those three because those are the three things that we can take care of. We can talk about increasing the income, we can talk about decreasing the household expenses, and we can look at different ways to deal with the debt. Now, if they're able to keep up with the debt that they have but they're not getting ahead, then we're going to talk about tracking their household expenses and getting a hold of how much their lifestyle costs. I'm really a fan of people knowing how much they cost. That way they know how much they need to earn. A lot of times we do it backwards. We know what lifestyle we want to live, but we don't know exactly how much money it's going to cost for that lifestyle. And we might not earn enough, so we put the rest on credit. So if someone's coming in dire situation, first thing we're always going to look at is how to keep them in the house or the rental property that they're in, how to keep their power on, how to keep food on the plate, and how to look for different programs in the area, assistance programs. If they're okay with their immediate needs, then we're going to turn to, can we negotiate with your creditors? Is the idea of a debt management plan a good idea? Can we call Citi or Bank of America and talk to them about your credit card and see if we can turn it into an installment loan with a lower interest rate and lower payment. A lot of it is communicating with the companies and seeing where the individual is at. So I hope I've given you some answers to your question there.
And if there's something else you want to know, just go ahead and type another question. I have a comment, and John, you may want to comment on this, from Susan, and I'm not sure where Susan's from, but it had to do with the buy here, pay here car dealerships, and she said, this is just something else to make our families aware of. These buy here, pay here car dealerships are not mandated to report on-time payments to the credit bureaus. So it's not helping their credit at all if, in fact, they are trying to rebuild their credit history. Any comment on that, John?
Yeah, that's absolutely right. In most cases, the buy here, pay here credit car dealers don't report to the credit bureaus, and although they do use information from the credit bureaus as part of their computerized programs to try to figure out just how much they can suck out of your pocket in the way of a car payment. So they're kind of a one-way user of the credit system.
Mm-hmm. Here's a question from from Charles Malloy of Marlborough County CDC. He's asking, how much capital is needed to support programs like the anti-REL program?
How much capital?
Yeah.
Well, I would say none per se. As a Vitasite, if you're able to join up with a financial institution where, in order for them to have access to your refund anticipation loan, they are going to open an account with that financial institution, and they are going to e-file. The only thing we do different than H&R Block with it is H&R Block gives them money as soon as they're done with the taxes. Ours, sometimes it takes 12 hours, sometimes it takes 2 hours to get a notice back from the IRS saying they have received and accepted the tax return that we've sent out. So the money is guaranteed. So the financial institution has zero risk in that situation. I'm not quite sure if I'm answering your question correctly, but if I'm not, I know I have somebody here at the credit union who could better explore that for you.
Okay, Charles, if you have, if he didn't answer your question, you can raise your hand and I'll try to have you live, or send me another question. I'll be happy to.
Or you can contact me offline and we can talk about it there.
Right. There's another question from, I'm not sure who this is from. Brendan, wonder how much does it cost to fund the VITA program? In other words, the Volunteer Tax Assistance Program that is a companion to the RAL.
Well, if you have a good grant writer on staff, you might be able to get away with really no overhead costs. We do a lot of grant writing to help cover the costs. We have one full-time staff member who gets benefits. We get an AmeriCorps Vista as a site supervisor as well. And then we have about 40 volunteers that those two individuals train and manage. We get some individuals from the Department of Social Services who are paid by the Department of Social Services to come on site and help. We also pair with numerous nonprofits in the area to tap into their resources. We get funds from the United Way. We get funds from our town and city government. We approach funds from other financial institutions such as HSBC. We really spread our hands out and ask for assistance in offering this because it is an amazing program and it doesn't really cost us much of anything.
Terrific. By the way, while you were answering, I got a little note back from Wynette, and Wynette is a Vista volunteer. So there you go.
Oh, wonderful.
Says, I am a Vista, great information, I'm a Vista volunteer coordinating 12 VITA sites, and this is a great way to incorporate financial literacy. Here's a question from Lisa. Are you aware of any programs, and John, this might be a good question for you, Are you aware of any programs that are successfully intervening and informing low-income families about these nasty nine?
Certainly, just about any financial education program out there is in some way or another doing that. And most families, some people call this financial literacy, but as Brendan was saying earlier, you've got to be careful about what you call things. If I talk about offering you a financial literacy program, you may take it to be saying me to be saying that you're illiterate, which is not a good thing to be. But everybody is a consumer of education. So financial education programs often accompany other kinds of activities. If I want to get involved in if I want to buy a home with a subsidized loan or an FHA loan, I have to go through a home ownership training program. Well, part of that home ownership training program is financial education. And so that's an excellent time and a common place to offer people information about some of these kinds of predatory activities. It's also a wonderful video, which some of you are aware of, that's been produced by the Annie E. Casey Foundation called "Avoiding the Money Traps," which is a rural-focused video about some of the nasty nine, not all of them, and about some of the ways that you can go about combating those. In many of the community groups working on rural family economic success that have been exposed to this video use those in lots of venues, like having them running on a continuous loop in the waiting rooms of the various agencies and places where low-income families may congregate, or working with employers that employ a lot of low-income people in their areas to run the video during lunch breaks. So there are lots of ways you can go about doing that.
I mean, you know, what's interesting about what John just said is that part of it, and I'm sure Brendan has experienced this, is how do you open the conversation? A lot of people don't want to talk about money. They don't feel safe about talking about money. So it's financial, and someone has, I think Wynette asked again, if we don't call it financial literacy, what do we call it? And I think the field has been making a move towards calling it financial education as opposed to financial literacy, for the same reason that John mentioned. When you call something literacy, it almost says, well, if I don't have it, then I'm illiterate, and people feel illiterate. So what's a comfortable place where you can bring these things up or at least start a conversation? So if people are already coming in to prepare their taxes, they're thinking about money and they're willing to talk about money in a way they may not be in another venue. Likewise, as John said, if you take something like the video, Avoiding the Money Trap, and you show it in a room, it opens the conversation in a way that it's very hard for you to do when you're just sort of one-on-one or in a group with people. Say, okay, who in this room wants to talk about money? I mean, a lot of people aren't going to want to do it. But if you show a movie that shows a lot of people who look like me who have this problem, I'm willing to say, oh, yeah, I've got a cousin who got in that problem. And, you know, 10 years ago or right now I'm having a problem. So it's opening the conversation is really an important thing. We have a couple other questions about financial education, and I want to take off mute our other colleague here at Aspen, Renee Bryce-Laporte. Renee, I hope you're listening, because he wanted to. Renee used to run the IDA, the National IDA demonstration at CFED years ago, but he also worked for the Office of Financial Education in Pennsylvania, and he wanted to make reference to a couple other financial education sources. Renee?
Oh, well, actually, I had what I had sent in to you, Janet, particularly talking about folks reaching towards credit unions to help them. There was a program there is a program in Pennsylvania run by the Pennsylvania Credit Union Association called a Better Choice program. Someone mentioned a program that was similar to this, where if you need access to credit, and the Credit Union Association has gotten many of their members across the state involved, so that applicants will get access to the credit. They will also, at the same time, get financial education. An account will be opened up for them at the credit union involved, and again, they're being charged reasonable rates for that. That is something that folks are moving towards in several states. You can look up online the Pennsylvania Credit Union Association and their program, A Better Choice program, and that's one of the resources that you might take a look at in order to get folks access to credit.
But that's thanks for that, Renee. I mean, so it's a statewide program where all of the credit unions in Pennsylvania are participating. So, and that required sort of some, I don't think it required any statewide policy change, did it, Renee?
No, I would correct this. It's not all of the credit unions. The credit unions themselves do have some autonomy. They don't have to participate. But the Credit Union Association has gotten a large number of them to participate voluntarily. You know, initially they were worried that they were going to lose their shirts, and actually that has not happened. The initial reviews are that the credit unions are receiving their money back, and that the customers have been protected. So it's really been a win-win.
Right. Now there is a question there's a clarification question here from Charles Malloy. And wait, on the prior question, actually, Charles, you sent me a few things, so I'm trying to figure out which one is relevant here. Just a second, folks. Charles says, we're a Vita site, and we're planning to work with my local credit union and ask them to support us in our efforts to make instant refunds available. Also, we're attempting to establish a CDFI, and we're looking for funds to combat the RELs and payday lending. So that isn't a question. Charles, I thought you had clarified your the other question that you'd asked, and I seem not to find that comment now. So glad to hear what you're doing, Charles. Thanks.
Janet, this might relate to his question about what kind of capital it requires, because
yes, I found it again. I found it.
Yeah,
again.
and I think what he might have been driving at is, you know, how much do you have to have on hand to make these things work? I mean, obviously, a credit union like Alternatives has to have enough deposits to cover those loans. And I don't think in the case of an alternative, they may be thinking about, gee, how much do I have to have in capital on hand in order to cover these loans, because it's a relatively small part of a much larger operation. So that's something that might warrant some exploration. You know, how many of these loans might a Vita site do in the course of a year? Brendan, I think you mentioned that a number, and if we know relatively what the amount is, we might be able to answer his larger question.
Right, and the clarification you said is the question is, since the credit union makes the loan, how much is normally needed out of your cash flow to cover the loans, which is what you just
It really
said.
depends on the refund amount.
Mm-hmm.
Depends on how much they're pushing these products, how many people they anticipate using these products, and obviously they're going to need the capital more up front in February, when a lot of the lower income folks are having their taxes filed as soon as possible, so they can have access to those funds which they need to live on.
Okay. There's a final question here that I have so far, and if anyone has any final questions, we're going to be rounding up in a minute. But the question is, are there any financial education programs that stand out in your mind as really working and having significant measurable outcomes? Now, this goes more broadly than just, remember, financial education is more broad than than things that have to do with lending education. It has to do with goal setting, setting up accounts, and all kinds of other things. Is there anyone that anyone on the phone can recommend?
I can't recommend a specific program, but what I can tell you is that a couple of years ago I looked at the research on when and how financial education works. And what the research shows is that it works contextually. Some financial education, people will absorb it and they learn the subject matter when they're struggling with a particular issue. So if you want to do financial education around, say subprime mortgage lending, people are likely to be able to listen to that and absorb that information and change their behavior when they're thinking of buying a home. So that's a principle to consider here, but I don't have a specific curriculum that I would recommend.
Yeah, and I would add in to John's point there. financial education, folks tend to come to it either when they're in crisis or when they have an opportunity. There are a large number of curricula that are out there. The number of curricula is actually immense. Actually, if you contacted the folks at my old office at the Pennsylvania Office of Financial Education, we have a room full of curricula in English, Spanish, other languages, and they would happily point you to some. But in the IDA work that we did, we found that about 10 to 12 hours of financial education seemed to work best for folks. Beyond that, the benefits sort of, you didn't get any graduated benefits after that point. But as John suggests, when folks have a real reason to use the learning that they're getting immediately, that's when they get the biggest benefit.
Well,
only thing I would like to add to that, Renee, is we have a financial education program here that we've dubbed MoneyWise. We've been using it since we started our IDA program 10 years ago, and what I've really found to be a successful component to it is the group interaction, the group sharing, the sharing of experiences in the safe environment it is for adults to come together and talk about financial matters. As we explore in our group, in our class, people don't like to talk about finances. It's kind of taboo. People don't like to talk about money. So to have a situation where you bring adults together and you make it okay and safe to talk about those things, we have a really powerful learning environment.
Well, thanks for that, and underlining the point I tried to make not quite as eloquently a little earlier. Thanks a lot, Brendan. We have reached the final hour here, and I want to just mention to you that we do have follow-up planned to this. The follow-up, you'll be getting an email probably within the next few days that will include the PowerPoint, will include a two-page handout that you can print front and back of a one sheet of paper summarizing the Nasty Nine in sort of a narrative. We'll send everybody the Rufus Family Focused Goals that I referred to earlier. We'll give you a link for the webinar recording and a link to an evaluation, as I mentioned earlier, and I apologize for our first-timer glitches in this webinar, but I hope that none of the mistakes we made lasted too long, I hope. So we'll have you a link to the evaluation about the webinar. On just the technical part, there's going to be a little pop-up survey right now after we end, just a quick thing on did you have any trouble with audio or whatever, but there'll also be an open comment box if you want to say anything else. And with that, I just want to thank John, my colleague John Molinaro. I want to thank Brendan Wilbur from Alternatives Federal Credit Union. I want to thank Elsa Noterman, who really helped us get this all together on our staff and has brought us up to speed on webinars, as well as my colleague Renee Bryce-Laporte for helping on that, but also for bringing his expertise to the table. But most of all, I want to thank all of you for the good work you're doing to try to help low-income rural families in this country. Keep up the good work. You'll be hearing about another webinar soon, and we look forward to your participation then. Thanks. Bye, all.